Listen carefully, because 2026 is not just another tax year, and if you file your taxes the same way you always have, you could be leaving money on the table, or worse, paying more tax than you legally owe. The IRS has quietly updated 2026 tax brackets. They've adjusted the standard deduction, and these changes affect every American household. Working families, retirees, side hustlers, and even people on Social Security. And here's the part nobody is clearly explaining. Some people will pay less tax automatically, while others will accidentally move into a higher bracket without earning a single extra dollar. So before you file, before you withhold, before you assume nothing changed, you need to understand what the IRS changed for 2026, why they changed it, and how it directly impacts your paycheck, your refund, and your retirement. Stay with me, because in the next few minutes, I'll break this down in plain English with real numbers, real IRS data, and real examples that apply to your life, not tax textbooks. Let's start with the first thing every American needs to know. All right, let's start with the most misunderstood part of the entire tax system, tax brackets. Because when most people hear new IRS tax brackets, they immediately panic and think, oh no, I'm going to pay more tax. That's not how this works. According to the IRS, and this is directly from their annual inflation adjustment release, tax brackets are updated almost every year to account for inflation, not to punish taxpayers. What does that mean in real life? It means the income ranges for each tax bracket are shifted upward, so you don't get pushed into a higher bracket just because prices, wages, and costs went up. The IRS calls this inflation indexing, and it's designed to prevent something known as bracket creep. In plain English, bracket creep is when you earn a little more money but end up paying more tax even though your real buying power didn't increase. So for 2026, the IRS adjusted the brackets again based on inflation data they track every year, the same data used by the Treasury Department and published on IRS.gov. Now here's the key thing most people miss. The U.S. tax system is progressive. That means not all of your income is taxed at the same rate. This is straight from IRS taxpayer education materials, and yet millions of Americans still misunderstand it. So if your income increased slightly in 2026, and you're worried about being pushed into a new bracket, you may actually still benefit from the IRS adjustments, especially if inflation raised the bracket limits more than your income increased. And this is where the standard deduction comes in, because brackets alone don't determine how much tax you owe. Before the IRS even applies tax brackets, they subtract the standard deduction from your income. And for 2026, the IRS also increased the standard deduction to reflect inflation. Again, confirmed in their official adjustment notices. That means a larger portion of your income is shielded from tax entirely before brackets even come into play. For millions of Americans, this is where the biggest tax savings actually happen. Not loopholes, not complex strategies, but simply understanding how the system works. Now let's connect all of this to what Americans actually care about: their paycheck, their tax refund, and their retirement income. Because IRS changes don't just live on paper, they show up in real money. First, your paycheck. When tax brackets and the standard deduction increase, many employers adjust withholding tables based on updated IRS guidance. That means in 2026, some workers may notice slightly less tax withheld from each paycheck, not because of a raise, but because the IRS recalibrated how much income is taxed. This information comes directly from IRS employer withholding updates, which payroll systems are required to follow. Section 1. What less withholding really means. Now here's the important part. And this is where a lot of people misunderstand what's happening. When you see less tax withheld from your paycheck, it does not automatically mean you're going to owe more money later. That assumption causes unnecessary stress. In many cases, and this is backed by how the IRS updates its withholding tables, it simply means the math has changed. Because in 2026, more of your income is protected before tax even applies thanks to a higher standard deduction and adjusted tax brackets. So instead of the IRS taking that money up front, it's allowing you to keep more of your own earnings throughout the year. Same rules, different timing. Section 2. Why refunds go up or down. Now let's talk about refunds, because this is where emotions really kick in. A lot of Americans think refunds depend on luck, timing, or some kind of tax magic. They don't. Refunds are simply the result of withholding accuracy. If too much tax was taken out during the year, you get money back. If withholding was closer to exact, the refund is smaller, or sometimes zero. And when IRS rules change, refund amounts naturally change too. Sometimes they go up, sometimes they go down. So if your 2026 refund looks different, that does not automatically mean something went wrong. It may simply mean the IRS adjusted the formulas behind the scenes, and your employer followed those updated rules. Different math, same system. Section 3. Why retirees must pay attention. Now let's talk about retirees, because this part matters a lot more than most people realize. If you're already retired or getting close, IRS bracket and deduction changes can directly affect how your retirement income is taxed. We're talking about pensions, IRA withdrawals, 401k, distributions, and yes, even Social Security benefits. The IRS doesn't look at these in isolation. They look at combined income. And when tax brackets shift even slightly, the amount of income that falls into a taxable range can change. Sometimes that means less tax. Other times it means planning becomes more important. This is exactly why retirement planners pay close attention to IRS inflation adjustments every year. Not because they're dramatic, not because they're flashy, but because small changes applied year after year can compound into real money over time. Section 4. The biggest mistake people make. And finally, here's the biggest mistake Americans make with IRS updates. They assume these changes only matter when it's time to file taxes. That's already too late. In reality, the smartest move is understanding these updates before the year ends. So your withholding, your planning, and your expectations are aligned with current rules, not last year's habits. Because the tax system rewards awareness, not panic. And the people who benefit the most are the ones who pay attention before everyone else does. So here's the bottom line. The IRS didn't overhaul the system for 2026, but they quietly adjusted it, and those adjustments can work for you or against you, depending on whether you understand them. Tax brackets moved, the standard deduction increased, withholding calculations changed, and the people who benefit the most are the ones who don't ignore these updates. If this helped you understand what's actually changing for 2026, make sure you stay connected, because upcoming IRS and retirement updates will impact far more than just tax season. Thanks for watching, and I'll see you in the next one.